Welcome to The Explainer. Today, we are digging into something you might not think about very often, the hidden risks of one of the most popular investments on the planet, the index fund.
So let's start with the story we've all heard. It's that simple, almost foolproof promise that makes index funds just so appealing, right? And look, for a lot of people, that story has absolutely been true.
Because here's the thing. If you don't understand how something can fail, you're just not going to be prepared when it does. This explainer is all about completing that story. We want you to understand exactly where the losses can come from so you aren't completely blindsided.
So here's how we're going to break it all down. We'll start with the myth, then look at risks both inside and outside the index itself. We'll even go beyond basic stock funds, cover some hidden flaws, and then we'll talk about your role in all this as an investor.
Okay, let's dive right in. We're going to start with the risks that are, believe it or not, baked right into the design of most major index funds.
So here's a weird paradox for you. An index fund can actually force you to buy stocks when they are at their most expensive and their most risky. We call this valuation risk. See, the fund doesn't care if a stock is a good deal. It just buys based on size. The bigger a company gets, the more the fund has to buy, no matter how crazy the price is.
And for a perfect example of this, just look at the dot-com bubble. The S&P 500 fund had no choice but to keep buying more and more tech stocks as their prices soared to absolutely insane levels. Then, when the whole thing popped, anyone holding that index fund just had to ride that roller coaster all the way down. And that's exactly what this means. You're just a passive owner. You have zero defense. The fund's own rules force it to buy whatever is hot and expensive, making you a part of these market manias whether you want to be or not. And since that system forces funds to buy more of the biggest companies, well, it leads us straight to another risk that's built right in, concentration risk.
Now, this is really interesting. You might think you're buying a nice, even slice of 500 different companies, but you're not. Not really. In reality, the top 10 giants make up over 30% of the entire index. So think about it. If those 10 companies have a bad year, your diversified fund is definitely having a bad year, no matter what the other 490 are up to.
And this really shows you the difference. On the left, that's your standard fund, and it is literally designed to be concentrated. On the right, you've got an equal weight version where the risk is spread out much more evenly. But almost everyone is buying the standard version, and most of them probably don't even realize how concentrated their bet really is.
Okay, so we've seen the risks that are actually built into an index. Now let's talk about the risks that come from what the index doesn't see.
You got to remember, an index fund is basically just a mirror. It only reflects one specific market. So if you buy a US-only fund, you could completely miss a decade of amazing growth somewhere else, like in Asia. Or if you buy a tech sector fund and that whole sector gets slammed, guess what? You're going down with it. There is no manager to steer the ship away from danger. You are locked in for the entire ride.
Ooh, this one is sneaky. This is the risk that the number in your account goes up, but your actual ability to buy things goes down. So you've technically made money, but you've actually lost real-world wealth.
And the lost decade is the perfect painful example. From 2000 to 2009, the S&P 500 had a negative real return. Yeah, on paper you might have broken even, but in terms of what that money could actually buy you, you went backwards. An index fund is just not an inflation-proof shield.
All right, now let's broaden our horizons a little bit. Not all index funds are tracking U.S. stocks. So what happens when you decide to invest internationally or in something like bonds?
So when you buy an international fund, you're actually making two bets at once, one on the stocks and a second one on the currency. This example shows you how you can be completely right about the stocks and still lose money. The Japanese market went up. Great. But because the yen fell against the dollar, your investment, when you brought it back home, was actually a loss.
And now for bonds. You know, the safe part of your portfolio. Well, their kryptonite is interest rate risk. It's pretty simple. When rates go up, new bonds get issued to pay more. That makes the older, lower-paying bonds sitting in your fund less valuable. Their price just has to fall to compete.
And wow, did this risk become painfully real in 2022. A classic broad bond market fund fell by over 13%. That absolutely shocked investors who thought their bond funds were safe. See, unlike holding a single bond until you get paid back, a bond fund is constantly revaluing its holdings based on what's happening in the market right now.
Okay, finally, let's look under the hood at the fund's actual mechanics. These are the small, but really important, ways the machine itself can kind of sputter and fail to do its one single job perfectly,
which is just to track the index. First off, remember an index is just a list of stocks. It's a theoretical idea. The fund is the real-world product, and it has fees and trading costs. That little gap between what the index does and what your fund actually returns is called tracking error. Second, some funds try to save money by not buying all 500 stocks. They use sampling instead. But sometimes that sample just doesn't perform like the real thing. And lastly, if a fund isn't popular, it can get shut down, forcing you to sell at a terrible time and maybe creating a big tax headache you weren't expecting.
So after going through all these risks, what's the big takeaway? Where does that leave us? Well, that brings us to our final and maybe most important point: your role in all of this.
The key thing to remember is that we have to stop treating these things like there's some kind of risk-free magic bullet. An index fund is a tool, a brilliant one, but it's a bit like a robot with a really simple program. It has absolutely no judgment. It will blindly follow its indexed straight into a bubble or into being way too concentrated.
And that right there is the core idea. Your job is to provide the intelligence the fund is missing. Understanding these risks, valuation, concentration, inflation, that is you providing the intelligence. The tool's only as good as the person who knows how, when, and why to use it.
Look, the point of all this isn't to scare you away from investing in index funds. Not at all. It's about making you a smarter, more aware investor. So the real question to ask yourself now